Thank you, gentlemen, for making an appearance. We have an absentee this morning in our panel, but let's get on with the discussion. The topic is what's hot, what's not with the hotel industry and hospitality sector as the perspective. Why don't I start this entire discussion by letting each one of you take about a minute, minute and a half to give your perspective from your respective areas of interest in this industry, and then we will start the panel discussion with some questions from my side. Sailesh.
Hi, good morning. From a sector point of view, as investors in the space, our approach has been to see whether, where are we actually looking at the sector from. It's been 10 years of deep cyclical challenges the sector has been facing. I think this is one of the sectors which have gone through the worst of times in the last 7, 8 years, 10 years after all the capacity came up. But if you look at from an opportunity that it presents from the next 5, 10 year point of view is tremendous. So all the pains which the sector has absorbed in the last 7, 8 years, survived, come out of the challenges, can actually present a case to making reasonable ROEs. We can't expect extraordinary ROEs from the sector because of the nature of the business itself or the traditional business model some of these companies run. But from the place where they are coming through, I think we are in for something very big in the sector in the next few years. Another interesting point is, I've not seen in many sectors so many companies not making money together for 5, 10 year periods. So I think this deep cycle which we are going through is an opportunity which it presents for investors like us from a 3, 5 year horizon. Plus, also we have seen companies change their models in these difficult times. So that also presents a case that we are no longer the same traditional businesses. We are orienting more towards profit, more towards return on investor money over relevant time frames. And obviously a lot of acquisition, a lot of activity happening, which creates interest and generates good, right, relevant capital to fund the sector.
Sure. Saurabh?
As a hotel company who's been very active in the capital market in the last year or so, one thing I can say is that consolidation is definitely hot for hotel companies. But beyond that, if we look at what has happened in the last year or so globally, and then we can come down to the India level, but it has been a very exciting year or year and a half from a transaction point of view. I mean, there were some remarkable transactions. Belmont acquired by Louis Vuitton, Hyatt acquiring 2 roads, of course us, our shareholders acquiring Radisson, and so on and so on. If you sort of analyze the trend, I think what's really hot is buying businesses, consolidation, again, as I said, growth story for all the brands, diversification into different fields as well. We also saw some spin-offs, vacation sort of rentals for Wyndham, for Hilton as well. So again, that was more focus on the core segment of the hotel companies. So yeah, buying sort of businesses are really to me, are the hottest things at the moment from capital investment point of view. What's not hot to me is real estate. Again, speaking at the global level, the yields are at their record low, which means that the overpriced assets, economies worldwide are sort of dwindling. They're looking weaker by weaker, with Brexit not helping, China facing recession or expecting to face recession, things in US being how they are. All that is causing an impact on real estate worldwide. So we've not seen, so from a transaction volume, it's been a great year. Most of it has been on businesses rather than real estate. And we've seen examples of real estate being divested, Accor being one example where with the booster program, we've sort of heard about Hilton, divesting the assets through the REIT, or Blackstone rather. So to me, asset is something which is not that hot at the moment.
Atul?
So we are very, very bullish and amongst the sector, this hotel as a sector is amongst our favorite. We are very, very bullish. We are very, very hot on this sector at this point of time. We like a lot of things which are underpinning the growth in this sector. I will not go into many, many factors, but some of our favorite statistics that we like to talk about it is that we are a very young and a vibrant country. In our country, if you look at the way this industry is structured, it offers potential across the spectrum. When I say across the spectrum, you can cut and dice it whichever way you want, whether it is the branded hotels to the unbranded hotels, and there the ratio is, I would say, 75 to 25%, where 25% are only branded, 75% are still the unbranded. Metros versus non-metro, people who travel for holidays versus pilgrimage. So the kind of opportunity which is there, whichever way you look at this sector, is making this sector really very, very hot. And at this point of time, all I can suffice to tell you is, as my friend Sailesh said, this sector was not the favorite for last couple of years, as a result of which the market capitalization of some of the listed entities collectively was not very large number. But it's only a matter of time where you will see this go dramatically up. And what is going to drive the growth of the market capitalization for all these companies is some of the factors that drive the growth in the hotel industry. We really, really like this sector. What is not hot in this sector, as my friend alluded to, is the time it takes to build a hotel. From the time you conceptualize it to the time you actually implement the hotel and you complete your trial runs and it's ready, you find that the cycle is turned around. And that is something that we have to be all very cautious about. What is still not hot is that the distinction between the asset owner and the asset operator. I think as we progress for the next few years, that will become a lot more clearer. And once that becomes clearer, the valuation will also be very, very different for the sector.
Yeah, thanks. So let me start with you, Sailesh. You pointed out, that the industry, especially in the listed space, because as the portfolio manager in Reliance Mutual Fund, you're looking at the limited opportunity which is there on the stock markets. You talked about the fact that the whole industry is coming out of a long cyclicality where we were looking at supply was outpacing the demand. I read somewhere that way back in 2008, the proposed pipeline was as high as about 150,000 rooms, which come 2018 has come down to just below 50,000 rooms. Now, clearly, this dynamic of increase in the occupancy rate is visible as far as the statistics are concerned. Are you seeing and are you happy with the way ARRs are moving? Are you finding, the financial statement, especially between 2015 and 18 now, in some of the stocks that you own, such as the Indian Hotels and EIH and Chalet, which was a recent IPO that JM did successfully. Are you seeing a portfolio that is looking credible in terms of your conviction to build a hotel portfolio in your funds?
Like I mentioned, the cycle was very deep. From those levels, you've seen industry profits definitely starting to improve. This has been more so in the last 2 years. 1.5, 2 years, You've seen improvement. But I think the sector is facing a challenge of psychology as well. They have seen so much of difficulty or so much of difficult times in the last 5-7 years. The push to drive pricing seems to be missing. I'm not saying that there is no effort to drive it. It is just that we are not seeing the kind of change which the upturn should really get to. Maybe it is elections around, maybe it's big events in India like DMON, GST, IBC, all of them actually impacted sentiments in the interim, but can have very longer term benefits coming through. But I think the whole journey is in front of us. The economics don't work. I don't think a single hotel can deliver sensible return on equities in a market like Bombay.
Right.
which itself is a telling statement of where either the pricing is or the cost structures are. And both the things have to be addressed by the sector to deliver. But yes, there is an improvement. The ARR upturn is there. Occupancies have reached, people say 5 out of 7 days in Bombay. A lot of hotels are running 90% full. So I think the journey is already underway, and you just need no major disruption. And with supply not being where it used to be, I think there is a big change possible.
So you talked about the return on equity, return on asset. These are the metrics, or these are the ratios that a financial market analyst or a fund manager is looking at, whereas the industry on the other side is looking at putting together the asset with completely different kind of definition for long term. Right? So you talk to any developer who's putting together a new hotel, he is putting it for a 30-year or with a 30-year vision. You, on the other hand, in the secondary market, look at 5 to 7 as long enough. How do you reconcile this? Does it make sense to hold on to something for just 5-7 years, whereas the asset may not still be as productive for a longer period?
See, the beauty of our markets is it prices a lot of things according to the environment in the near term. That allows you to get a differentiated value for where you're investing for. So somebody who's investing for 50 years, 40 years to create an asset, it's very, very good. I think it's not an issue of that. But are they respectfully or are they relatively relevantly capitalized for that? If you're doing it with significant leverage, it doesn't serve the purpose at all. I mean, you've seen the challenges in the sector. So I think having the right capital ratio when you create an asset, and then you have a time frame which is appropriate. Other thing is, it's all very good to do a 30-40 year project, but the way things change, I think if you can't demonstrate over a 5-7 year period sensible profitability in the business, even after a reasonable economic activity, last 7-8 years have been very difficult, so I'll leave that as an exceptional period which we have seen. But I think in a 5-7 year period, any business should be able to demonstrate that there is a path to profitability or availability of return on equity. From an equity investor point of view, I think equity markets and secondary markets, the hotel sector is so underrepresented that it's not funny. Yes. You hardly have 3 hotels, 4 hotels which are material or listed. Combined market caps are very, very small. If the market is doing something wrong and not valuing them properly, I think that's one way which even the industry has to correct to be able to demonstrate. Second is, in a hotel sector, right, when so much of capital is committed for a longer period of time, our case is the disclosures of companies in those spaces should go materially higher. There's a way difference in terms of how international companies report data to investors and create a track record as to what they are trying to deliver. I think we are early in that journey. I think if leaders can take the lead there and demonstrate much better disclosures to investors, you have a big story from a capital market point of view. And for us, the deeper the cycle, the bigger the advantage.
Sure.
Because that's where you get to hold meaningful positions and leading players.
Sure. Saurabh, you have put together 2 recent transactions. You took over Saurabh in 2017 and very recently Radisson. What were the drivers that you were looking at to not only implement perhaps a global strategy that you follow of being asset light rather than doing the development? Because now that the 2 acquisitions are complete, I would like to know from you, how's the organic growth that you're looking at? Are you happy with the acquisition in terms of, a lot comes out after the acquisition is over? Anything that is not hot post the acquisition?
Yeah, sure. I mean, there were 2 different transactions altogether. The first one was Saurabh in 2017, which to me till date, I think for us, we were fortunate enough to do that transaction, and a transaction of that does not exist. Or that kind does not exist in India. So we've been quite fortunate that we were able to conclude that, and we've been extremely happy with the whole thing. I mean, I don't know if many of you know, but we actually, when we did the Saurabh transaction, it was done without due diligence, and so even more, people told us not to do that in India, but we believed in it. We liked what we saw, and it's just been a great benchmark for us and a great success story. The results have been fantastic. The growth's been fantastic. yeah, I mean, it's just a perfect, dream transaction for us. The Radisson transaction was sort of more, was a different one. It was done by our shareholders, Jingjiang. It was a transaction done in China. It was acquired from another Chinese entity, HNA. Strategically, it's a great fit to the whole portfolio. It's actually it's not only complementary, but very synergetic. The presence is complementary outside of China. It sort of enhances. When we were looking at, we were looking at a potential target, which would give us presence in US, which would enhance our presence in Europe, enhance our presence in India and in Asia. And Radisson just ticked all the boxes, and being asset light as well.
Yeah.
For us, we are restricted to invest into real estate because we are governed by the Chinese investment policy, which restricts investments into hotel real estate. So we were looking for an asset light platform, and here it comes. I think it's early to say what comes out of it, because we've just closed the transaction there. But the idea is now, we have the size. We're now the second largest hotel company in the world. We've done a lot of acquisitions in the last 3 or 4 years, and the time now is to absorb all that, and we're all working together for a common strategy to unify all that and roll out sort of one brand as an entity.
So the strategy is pretty much in line with what you're doing globally and internationally in other places. Comparable to the Accor strategy as well. So is there a thought process of looking into a joint venture to accelerate some of the, the penetration into this market? Because as Atul was pointing out, the drivers are there. I think there is a complete change of mindset in terms of who could be the consumers of this particular service, domestic, international, business, leisure. He talked about pilgrimage, which is a big thing. Are you happy with what you have put together on the portfolio now, or is there more that one could expect in the next couple of years from you?
Look, I think it's not fair for me to comment on any strategy with Accor. It's a completely different setup altogether. I think what I can talk about is what we're doing and what our strategy is. For us, we still think there's a gap in the luxury space for us as a group. So we're looking aggressively at a luxury brand. We're also looking at diversifying. We see potential in the leisure space, in the resort space. And again, I forgot to add at the beginning when we were talking about what's hot and what's not. I believe since the last sort of economic downturn, the deep recession, the only sort of element of hotels which has been profitable throughout and growth-wise and profitability-wise is the resort sector. And we've seen a lot of activity in the last few years as well in that space. And I firmly believe that there's more to be done there. And for us, most of our hotels are business hotels, so it sort of enhances diversifies our presence as well.
Atul, you talked about the capital market related interest in this sector, and you have been very close to Leela. I don't know whether you want to talk about it yet, because it's still not complete. But if you could shed a light on the Leela transactions from the point of view of how the stressed assets in this industry, if they were to find exit and resolution, how much of it could change the landscape? And then, of course, I will ask you to even talk about a new IPO that you did for Chalet. The last time an IPO came from this sector was, I think, mid-90s. So what is the hesitation? Are there more that you are going after in terms of the listing on the stock market?
So with the permission of Mr. Sethi, I'll first speak about the Chalet Hotel. So Chalet was the reopening of the capital market. It was an IPO by a hotel company after a very long period of time, because there were two of them which happened in quick succession, the Lemon Tree and the Chalet. So both these IPOs came, I would say, after almost 15 years, and that is what me and Sailesh were discussing. Both the IPOs were very well received. Both of them have done very well in the market. Both of them trade at an approximate value of around $1 billion, give and take a few cents here and there. Both of them have been very well received. The underlying principle, and this is very important, forget how in past hotels have been valued. As India becomes a part of a global village, and as India gets more integrated, as India gets more institutionalized, the money is going to flow to the most efficient operators. The money is going to go to the most profitable companies. And I don't think so Indian companies are any different from any of the major foreign companies that you can talk about. So we are going to have a very similar structure, maybe evolving at a speed which is faster than what it would have historically taken us. A time is not very far away where we could see hotel operating companies as very different from hotel owner companies. Today, if one was to fundamentally value East India Hotel, it trades at a fraction of the value of what the underlying assets are in it. Okay, but it's again governed by what's the profit it's making. So somewhere either the asset value has to come down or the profit has to go up. You have to find an equilibrium somewhere. It cannot continue in this space for a long period of time. What we are also very, very keenly seeing, and I will come to the stress asset situation, I think acquisition is going to be the order of the day in this industry. We have not seen many acquisitions in this sector. I think a time has come where both in the organized sector as well as the unorganized sector, metros as well as the non-metros, we're going to see a huge kind of alliances being formed. And I think the big is going to get bigger. And there is no scope for, one of the things that I don't like is individual hotels, one hotel company or two hotel company. I don't think so they will survive for a very long period of time unless it's something very, very exclusive in its nature. Coming back to the stress asset, yes, in past, like many sectors, this sector also made the mistake. It got over leveraged, and as a result of which it ended up being classified as stress asset with the banks. There are many hotels which are lying with the banks as well as the various ARC companies which are stress asset. Over a period of time, because of the various reasons, including change in the cycle, there is a huge demand that we are seeing for these stress assets, and they can be turned around very quickly. Let's not forget, in India, creating an asset is very difficult. We were discussing this offline. To get a hotel up and running, it takes almost 115 to 130 approvals, which is a task by itself. If you have something which is ready, which is probably fractured, you can put the cast around and align it and get it going fast. So we are seeing huge amount of interest. Leela, I will come to it. I'm not shying away from answering that. But we have seen interest from Blackstone, who went and picked up a stake in Wits Kamath Hotel, for example. They picked up a stake even in Hyderabad-based hotel. And now I come to Leela. Leela is an asset which everyone knows. It's well documented. It was a stress asset. JM's ARC picked up the debt in it, and by virtue of it, we had a control over that asset. And we put it up. We spoke to various strategic investors, and we found a suitable suitor who was willing to pay us a good price. And eventually, with the consent of all the banks, now the document has been inked. I hope the transactions sees the end of the day very quickly, and that's in it for us. It has been sold at a value of almost 4,000 crore, little short of 4,000 crore, which is $700 million approximately, in which the 4 key hotels and some of the hotels where they have the management contract will pass on to the Brookfield related company, and they will run it like any other asset management company and take it forward. This is what these 3 examples tell us.
So many acquisitions, many new suitors, a lot of new capital that we are seeing in the recent years that has come into the industry is actually coming from outside, right? Is coming from outside.
Yes.
Right? So whether it is Blackstone, Brookfield, the Louvre, all of it has started looking at this particular opportunity, which is, very clearly present in front of all of us. For many years, I thought, and I think all of us understood that Taj and Oberoi as brands understood this market like nobody else did. Not only in terms of the locations, but also in terms of the service culture, cuisine, everything, right? So what has gone amiss in terms of Taj and Oberoi actually not being the natural acquirers of some of these assets? Is it the access to cheap capital? Is it lack of vision? I mean, where is it? Or is it that we just get too hard in terms of bargaining the right price?
No, I don't think so. The Taj and Oberoi, none of their assets are up for sale. I think whenever Taj and Oberoi have bidded for any asset, I think they have been successful. They have, I would say, as of now, a right of way kind of situation. Whenever they have raised their hand because of their good reputation, I think they had a fair chance. I think because of the industry nature, the downturn that this sector went through for the last, I would say, 5 to 7 years, balance sheets were stretched, balance sheet was stressed. Nobody made an honest attempt to do some major acquisition. Now that the balance sheet has been corrected, repaired, sector is doing well, you will see a lot of interest. We have with us Sailesh, who is one of the largest owner of hotel sector. You probably name a company and he is the single largest shareholder in those companies. So we have great interest from Indian institutions who's interested in it.
Then of course, we know that you sit on a portfolio with 8% of Indian hotels, 6% of East India.
6% of chalet now.
Yes, 6% of chalet now. But I mean, in your own evaluation, when you do your back of the envelope calculations, or you have management meetings with some of these Indian hotels, would you rather see these Indian hotels have access to cheaper capital? And is it even a possibility that we should not look at Indian hotels being listed actually abroad?
The need for cheaper capital for the hotel sector is really, I would say, as important as anything else, because like I said, the tenure or the time frame of turning a hotel and creating a value out of it is definitely longer. So it's everything for a longer tenure asset, longer tenure business you're trying to create, you need access to capital. Second, the deep cycles which happen in the sector, right? I mean, some of it is a function of the external environment. A lot of it is also the function of kind of leverage companies live with. So when you have leverage, that becomes your focus point. I mean, the business takes a back seat. So I think a lot of these things happened in the last 10, 15 years because of the challenges the economy faced and businesses faced, right? As equity markets, right, there is a capital available for this sector from an equity market point of view, provided there is a visibility or a part to profit, which has been the case now, 2 or 3 guys coming up, and now you've got a lot of assets and transactions happening, which actually adds to the value. I think it's more representation.
Yeah.
The sector is not mainstream. It's so unfortunate that a sector in this large economy today is not mainstream for whatever reasons. So as it gets mainstream, capital will be available, right debt equity ratios will be there. And if you right price, have rational business models, definitely I think the amount of capital available for the sector will not go. You mentioned about some of the brands which are there in the industry. I think they are iconic. I think there is, our cases generally, a lot of these brands are significantly underrepresented by value in stock markets, or how they are being valued versus how their business strengths are, how their practices are today. So I think it's a journey. It's more about greater engagement from the sector, the capital market point of view, which will derive value from both sides.
Right. You mentioned it twice about disclosures. And I'm sure you and your analysts pore over the financial statements of the stocks that you own and the stocks that perhaps you have decided not to own. What is it that you are not seeing? What is it that you are not seeing in the disclosure?
See, as per whatever regulations are there, they are all being perfectly followed.
Yes.
So it's not a challenge from that.
Yeah.
To get a mind share of an investor, right? Any company will have to start looking at how its business is doing from an investor point of view also.
Yes.
Like you said, a business is built for 50 years or 40 years and all that. But when you communicate, if you have greater information as to it's moving in the right direction on a reasonable 3-5 year basis, it'll count a lot. Given that this sector also has much less investor interest generally versus other spaces.
You mean the disclosure about the forward-looking vision?
No.
Strategy?
It's the strategy.
Yeah.
Whether it's working or not, it's about what kind of investment matrices people are willing to follow, where will the next few thousand crores of capital which you will generate or invest go in the next 3, 4, 5 years.
Yeah.
See, it's ironic that this sector has a 10, 20 year kind of a time frame to talk about or work on, whereas the communication is generally rolling 1, 3 years. So I think it's a combination of directionally communicating for the next 5, 10 years, what's your approach, then trying to granularize it a little bit in terms of how the progress is or how the progress will be. Plus, a lot of companies don't give region-wise profitability. They don't share the real return on capital employed per asset.
Per property.
In some sense, per property.
You would like to have
Critical,
that kind
yeah.
of,
Top
the
10
way we
properties,
expect segmental revenues, you would
Yes.
like to see data points for properties,
Sure.
right? For example, what is it the Mumbai properties are doing? Would you like to see ARR property-wise?
Certainly. These are things which are considered strategic by people, but a lot of international guys give all this data in region by region, category by category. So whatever is relevant from getting investor interest back into the sector,
Yeah.
I think this is one important piece. I think this will be valued much, much more.
Right. Saurabh, I turn to you again to see as to where the global international markets are with respect to the asset-light strategy, management contracts, as against, even Atul had pointed out, as against developing. And he briefly talked about the number of approvals required to put up a hotel in India. Where do you see and how do you compare India versus some of the other markets?
It's very different. If I compare Indian real estate to European real estate, where I have or we have a huge exposure of, it's a complete contrast. I mean, in Europe, we look at yields of 5 to 6% at least, and that's sort of because the overprice and so on. Still, you can get yields of 5, 6%. The cost of debt is rather cheap. It's 2%, so sort of 1.5 of Euribor. So, so you're actually sort of your hybrid or net yield to you is still 3% or 4%, plus the appreciation. But if you move that to India, the yields are virtually non-existent. The cost of debt is rather high, plus the currency factor which fluctuates quite a bit. But everything sort of is banked on the appreciation, which works and the history has shown that it works. But it's just something which is very difficult to underwrite for us as a European company. So asset investment in India has always been a tricky one for us.
Right. There is a new kid on the block, which is the REIT, right? And we have read and seen the Blackstone REIT, and I believe there is something in it even from the hotel industry. Just your thoughts on it. What does it mean in terms of igniting the interest in this sector through this particular instrument?
So, as I said, as India gets more progressed and aligned with the world, we are going to see ourselves into a situation where it's an asset-light company, which is a pure operating company versus a hotel owner company. Even if they own hotel, it's going to be very few marquee properties. It's not going to be a situation where you own all the hotels that you operate in. So a time is soon coming where we are going to see a shift where these hotels are going to be pumped out into a separate company, which could be called as a REIT company, which would go to the public and offer its units to the member. We have seen a very successful listing this Monday, where Blackstone Embassy REIT got listed. It had a hotel embedded in it. To my mind, that's the beginning. And you will see over a period of time, hotel-specific REITs coming to the market. And these will own hotels all across the world. This will own all hotels all across India. So this is in line with the trend. And I think the time has come for this idea to be taken to the next level. Historically, it has not happened for a variety of reasons which we all understand. But I think the time is coming for it now to get implemented. And what is going to drive this is, again, as I said, the capital is going to go towards the most efficient side. You look at what happened to OYO. OYO has been able to raise money at a market capitalization which is greater than Indian Hotels and East India Hotel put together. So again, it goes to show that the investors are favoring an asset-light model versus an asset-heavy model. Okay, so the light is going to draw upon the people who are there in these companies, that do we need these hotels to be here, or it can be somewhere else. As long as we show the profitability, investors like Sailesh are very happy. So we need to make them happy, and at the same time give the asset to somebody who's going to give us a value.
Sure.
What is important, one is capital. What is going to drive is the huge buoyancy in India. Let's not forget, in India we have 130 crore people. All these people are young, aspiration. Times are changing. There was a time when going on a holiday, vacation was a taboo. Today people are not afraid, not scared to go on a vacation. So when you go on a vacation, you will stay in some hotel or somewhere you'll spend money. Look at the airports, they're choco-blocked. Every airline that flies out of India or out of any city, major city in India, you see they are blocked. All this is going to fuel towards the hotel. I think that's why we were very, very bullish on it, and we continue to remain very, very bullish on this sector.
Excellent. We have last few minutes before we wrap up. Why don't I allow some questions from the floor to the panelists? Yes.
So thank you very, very much. You talked about the problems of the industry with the kind of lucidity and transparency that we're not used to hearing as owners. I think everyone agrees that the growth in this sector, whilst it does need to, is tending to become more mainstream, but the growth at least in the short to medium term, will have to come from individual owners trying to build hotels. Please tell me if you disagree. Whatever's happening with the organized institutional sector within the hospitality industry. That said, Saurabh, I truly appreciate what you've said, and I haven't heard people saying before that what the yield is. In Europe, you said the yield was 5 to 6%. I've lived most of my life in Europe and the US. The cost of debt is 2%, growth is 1.5 to 3%. And there you can actually appreciate and understand capital appreciation. Whereas here in India, and I appreciate your honesty, the yield is non-existent. Cost of money is very high. You guys must be luckier than the rest of us, 10 to 12% if you're lucky on this side of the aisle. And India is growing. We heard Amitabh Kant telling us yesterday at 7.5% GDP growth. Inflation is 7%. So if you had 100 crores of rupees as an individual, whether your background is real estate and however you've leveraged that 100 crores, tell me why in India and choose your sector, would you invest 100 crores of rupees?
Hotel space, and we invested in a platform here.
No, not as an institution, with respect, not as an institution.
As an individual.
As an individual.
As an individual. Still the same.
Consumer market is sort of the term which comes to my mind first. And again, I'm biased towards this sector. So as an individual, I would buy, again, not real estate, but a platform, a business in hospitality here.
I'm sorry, could you say that again?
A business, a platform here. No, not real estate, but just a business in hospitality.
Based upon which financial outcome measure? You know, we talk a lot about the input measures, ARR, RevPAR, TRevPAR, different things like that. But if you look on return of capital invested, if you look on unencumbered cash flow, if you look on return on net asset, which number makes you say that?
So again, real estate does not make sense to me personally, so I would not invest into real estate. So the return on capital employed for real estate does not work. But for a business, I'm biased towards hospitality because if you're buying a business, you should buy a business which you understand and know. And the fundamentals of the business are all there. We've been talking about the penetration of branded rooms versus unbranded rooms. I mean, it's not comparable to any other mature or maturing economy in the world. The way forward or what lies ahead is actually quite, the quantum of that is huge. And that is very exciting for us in this space. There is still a lot of potential in hospitality. Again, the consumers are growing. I mean, we've seen what the OEs have done to in this space. And there's still a lot more to do.
Shailesh, do you want to supplement something?
See, from an equity market point of view, like you said, the returns are pretty low, and we also understand it's the problem which the sector is going through. Because the returns are low, the amount of capital which will get attracted to it, purely asset creation, because that's the real model today in India. I mean, the model towards asset-light strategy is underway for some time, but it's a journey which is yet to be achieved. Existing businesses have to do exceptionally well over a period of time to make capital available at low cost of capital for this sector. I mean, that is what I think is fundamental. So if new properties or new businesses or new hotels cannot make sufficient return on equity, or even over a 7, 8 year period, I think the lesser amount of capital will get attracted to the sector, creating some sort of a 2003 to 2008 cycle again, some sort of a cycle again. I think that is the opportunity from an equity investor point of view. From a business point of view, like you said, asset light, asset right, because at 13, 14% cost of capital, 2 years delays, no business can make economic returns unless you're buying the asset way below the current prices which exist.
Yes.
Thank you for an interesting session. Quick question to Saurabh here. Saurabh, if everyone thinks that asset light is the way to go forward, who's going to build the hotels for you?
So again, Sanjay, as I mentioned, real estate deals work in India. It's most of, I mean, all the transactions we've seen in India, most of them have shown some sort of an ROI. Now, as an external investor who's not here in India to underwrite low yield but high capital appreciation, it's something difficult for a non-Indian entity. But in India, it works.
My concern is that we've got 10 global brands, 5, 6 Indian brands saying that they're going to grow, 100% of their portfolio in the next 5 years through an asset-light model. But if there is not equivalent interest in building those hotels out, how are you going to grow? So someone needs to build them out. Absolutely. If it doesn't work for you at a cheaper cost of capital from Europe, how will it work for us as owners with more expensive cost of capital here? I think the only way it's going to work is if brands decide to make the hotel operations more efficient and not restricting themselves to GOP levels, but looking at, maybe profits before taxes levels.
And that's a perpetual question, Sanjay, because as a brand, as an operator, you don't control anything beyond the GOP level. Whilst I understand, I think the answer, again, and it's an evolution, and which would happen in India and outside as well. To me, the next generation of hotel managers need to be asset managers as well at the same time. I think that's where it all sort of would lead to.
I think the answer to that is that a lot of the hotel management companies need to get their talent pool to develop as business managers, not just as operating managers. And that's going to be a key differentiator. Yes, you've been talking about for 24 hours now.
If there are no more questions, then the time is up, and we will bring this session to a close. Thank you, audience, and thank you, panelists.
Thank you very much.